Good morning, Wolfpack. Let's go get them. Kidding aside, I wanted to synthesize some ideas. I promised you guys I'd come back with some simple ideas that you can put to work the second half of this year, okay, to hopefully outperform the market. We've been talking about a lot of this stuff for some time. As clients know, October of 2023, we started to shift things around, but then we've gotten a little bit more tactical. I did a longer video. This is going to be a shorter one. Just again, some simple things that we can do. And I'm terming this splitting the uprights. We are almost at football season. Almost there. So it's a perfect title, I believe. Splitting the uprights, meaning right down the middle of the goalpost. Why do I say that? Let's get into the themes we've been pounding away at, right? The interest rate theme. Again, we had terminal interest rates in October of 2023. Right, 5.01%. We're down 75 basis points, or 0.75% since then. That trend's going to continue. There's now a 100% expectation. And remember, it's all about expectations. You hear about me talk about that all the time, that there'll be a Fed rate cut in September. If that does not happen, Armageddon. All right, election and Gen AI. Those are two other themes that we highlighted in the longer piece when I did the mid-year update. Those stay prevalent. What's changed? We got Kamala. Right, Kamala's in the race now, so we got a little bit more of a horse race. Right now that Sleepy Joe's out, going by Vegas, screw Gallup, okay? Trump is now 1-2. Kamala Harris is 11-4. Okay, those are the odds on the election. We're going to get a little bit more neutral with some things that we've already been invested in, but because of this, we're going to stay there, and I'll highlight those. All right, so allocations, we talked about the 40, 40, 15, 5. Okay, so 40% stocks, 40% bonds, 15% what I call my alternative investments, and 5% is going to remain in cash because we can still get 5.28% from something like the Vanguard High Yield Money Market Fund or the VMFXX. When I give the symbols, that's what they call a ticker. So this is what you'd plug in to actually buy something like this. The VMFXX is currently yielding 5.28%. So that's that's still a good grab on the cash, right? Okay, anyways. So for our stocks, 40%. Okay? You've been hearing me talk about how because tech's a little long in the tooth, I've been talking about that for about a month now, right? Particularly as we moved closer to earnings season. We got some big ones coming up this week. We've gone from 100% allocation in the SPDR as part of a core allocation to a 50% 50-50 allocation between the SPDR and the RSP, which is the equal weight S&P 500. We've talked about this a lot, right? The Magnificent Seven comprise 30% of the S&P 500 performance, right? So that's a lot of that's obviously a lot of the tech and communication services names. So we're going more equal weight on the S&P. QQQ, we've reduced allocations there because it's tech heavy. This is exposure to the NASDAQ 100. But what does this also give you? Biotech, okay? So it gives you exposure to biotech, companies like Biogen, Amgen, right? They're still gonna be there. And then for more income-oriented portfolios, we use the SCHD, which is the SCHD, the Schwab Dividend ETF. And of course, the one that's worked out for us pretty well as of late, right? The OMFS, or the Russell 2000 ETF. So we've been, as you know, on July 7th, after balancing my root chakra and having an epiphany, we went overweight small caps. Turned out to be okay. They gave back a little bit yesterday, but that's just general rotation and profit taking. Perfectly normal. We are allocated the right way there. You don't want to chase here. Leave it where it is. International allocations, we have the VGK, which is the FTSE 100 Europe, and the VWO emerging markets. We're going an equal split between there. We were overweight the VWO, which is emerging markets or emerging economies. Why was that? Again, they are sensitive to high interest rates. They're laden with a shit ton of debt. So they borrow a ton of US dollar denominated debt. When interest rates go down, it makes it easier for them to service those debt payments. And when interest rates go down, what happens? Currencies go down. So the US dollar goes down versus their currency, right? So we're going to go 50-50 again between the VWO and the VGK, which is Europe. I am overweight India. Buy this one, put it away. It's the iShares India Large Cap ETF, the INDA. Okay, and then sector specific, right? We made some tweaks here in sectors, right? More from like a technology bias to more of a economically sensitive bias / defensive bias. And this is going to give you both a Trump and a Gen AI play. You say, why Gen AI? Okay, so here in sectors where we're overweight, XLU, utilities. These aren't your stodgy, boring utilities that your grandparents used to clip coupons on. Utilities now are the grid. The grid is strained, and guess what? It also takes a shit ton of compute power, right? For all these new data centers that are processing, ingesting all this data for Gen AI. Okay, so the XLU and the XLE energy, which we added that one back in June, okay, that's also a factor here, obviously, because energy plays into the grid. The XLI, industrials, we essentially have 3 wars going on. There's infrastructure spending still going on. We're overweight industrials, and this is a splitting the upright play. We're going to stick with the XLV, which is the healthcare ETF, right? So it's going to give you exposure to broader healthcare outside of the biotech, a lot of the pharma companies, okay? We're going to stick with the ICLN, okay? That's the clean energy ETF. That is not going away, okay? Even if Trump is elected, there's still going to be a move towards cleaner energies. This thing has gotten hammered, okay? We think it's as a relative value play for a theme that's not going to go away. You want to be long the ICLN, and then the XLF financials. Financials are going to benefit. We had the small banking crisis in 2023, at the beginning of 2023. So particularly regional banks got hammered, but financials are going to factor more prominently as we get to a more neutral interest rate. They make money on what they call net interest margin. So essentially paying out crap for deposits at the short end of the treasury curve and what they're receiving at the longer end of the treasury curve on longer end of loans. So as interest rate comes down, there are also big consumer plays. Consumers are in theory going to start borrowing more and spending more money. So we want to stay along the financials, and also regulatory environment, particularly if Trump gets elected. There's going to be an ease, or at least a perception of ease, on regulation. So financials, so the XLF. These are all the SPDR. For sectors, I use the SPDR products, which are State Street. Props to State Street. Individual names, and these are Gen AI plays. Okay, so Gen AI, right? We have the energy play of Gen AI, because again, to ingest, process all this data going into Gen AI, large language learning models, blah, 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 lions, tigers, bears, it takes energy. So we have the energy play, and then we have individual names. The phase 1 names, the hyperscalers, Google, Amazon, Microsoft, you got to stay there. Names we've been adding, Apple. Apple's late to the game, ironically. You would have thought they'd been quick to the game. They got the new Siri, which is going to cause an upgrade cycle. And now that's kind of an emerging Gen AI play, if you can believe it. Avago, Broadcom, think of this as the networker, the social person of Gen AI. This is the one that patches together all your large language learning models. It's the patchwork that kind of brings everything together, and it's an Apple play. Okay, so Avago, AVGO, Snowflake, Tesla. You've heard me talk about both of these, right? We know the levels there. Tesla's held that 225 level we talked about on a weekly basis. We like that one. I think it's trading 232-ish right now. Stay neutral there. And Snowflake, which was late to the game with Gen AI because they don't have machine learning in their data warehouses. They have a good fundamental base of clients, and they're catching up, and they will catch up. It's a very smart company. So we like Snowflake. Here's some lottery tickets that we're playing as tail trades. I call them lottery tickets because there's some risk here to these names, but a couple of them are performing well, a couple of them have not. But if you want to take a little bit of cash and play some, higher beta names, we are playing in Shopify, SHOP, Spotify, they're learning how to monetize advertising, SPOT, Chewy, right, which is the online pet company. 12% of the outstanding interest in Chewy is short. You saw my article that I wrote a while back, or maybe you saw my article, I wrote one on contraindicators. I watch short interest huge. Why? Because all the people that are betting against the company when it's that high, right, have already placed their bets, right? So the market moves are typically opposite of what they're doing by the time you get the short interest reading. Okay, if that makes sense to anybody. So Chewy's one that we like. And CrowdStrike, they had a big gaffe, but you know what? Buying opportunity. Cybersecurity, not going away. They'll patch their models and they'll be back. CRWD. Okay, bonds, 40%. Duration. I want to think very simply about this concept. Okay, duration is essentially for every percent move in interest rates, okay, the price of a bond, which is inverse to yield or interest rates, is going to move X amount. Okay, so if interest rates go up 1%, the duration would be what the price of the bond would actually go down. I want you to think about in terms of matching your bond portfolio with your time horizon. Think of duration in terms of that. So you get an average duration on the portfolio. So for longer term, simple, cheap portfolios, we're recommending things that have a little bit longer duration. Okay, so we're recommending the TLT, the 20-year Treasury ETF, because it's going to catch up in price at a higher neutral interest rate, so it's still paying a decent yield. The LQD ETF, which is your high investment grade bond ETF, so companies that have an investment grade rating. The HYG, which is the high yield bond ETF. The TIP, U.S. Treasury inflation protected securities, we're still sticking with those. I like them. They've been lagging. And I put the PFF, preferred stocks. Citigroup and Morgan Stanley just issued some great ones. It's typically financial companies. I put the PFF under my bond allocation. Why do preferred stocks, why are they so sensitive to duration? They have unlimited duration. Okay, meaning there's no time that it ends and you get your $25 back that you paid for the preferred stock. It's unlimited. Okay, so they're highly sensitive to interest rates. Interest rates coming down. We like the PFF. It's got a 6+% yield. Alts, 15%. Blackstone and BXSL, Blackstone's lending portfolio. Great way for the everyday common man to get exposure to private equity, real estate, and mezzanine funding, okay, or loans. All right, so those are two plays, BXSL, the RQI, terrifically managed real estate company. That's the Cohen & Steers Real Estate ETF. The IYR is the iShares REIT property focused ETF, not mortgage. Stay away from the mortgage stuff still. Rates are still relatively high there. The GLD gold, the SLV silver. We've been shifting more out of gold, given the move higher, into silver, which has more utility as a conductor. And the FBTC with Bitcoin, you want to be with this a little bit, particularly if Trump gets elected. He's talking about having it as a reserve, okay? I'm sure it's appealed to some voters. That'll be tough to get through, but still, it'll go up on that perception. We talked about this. Traders trade what they see. Stay present. Eckhart Tolle, stay present. Cash, 5%. US T-bill ladder, okay? I like to do this. You can do this to match it to expenses. For instance, you just bought a house, you're renting an apartment. You could do a 4-week T-bill ladder to match those expenses and basically pay your nut from the coupon, right? So go anywhere from 4 weeks out to a year. If you don't need the money, lock it in. Lock in the 5+% for a year. Okay, so US T-bills and the VMFXX, 5.28%. We talked about that. That's a good place to park some cash. As always, reach out to me with any questions that you may have, any help that you need. We've been welcoming a lot of new clients. Welcome. And no DMs on the weekends, please. Much gratitude and appreciation for the questions. Use our Contact Us form on our website. For me, this has been the summer of simplicity and essence of life, getting back to the simple things in life, really tapping into that sacral chakra, to my inner child, camping, hiking. I love to do that stuff. There hasn't been as much in Nantucket, things like that. No, this is the summer of simplicity. God bless, as always. Go Wolfpack.